How do you do this? There's two ways. One, you concentrate to get rich. You do what Patrick and I did. You build a company. See, it's really the only good way to do it, but it also comes with the risk of round tripping. And so when you're rich, when you wake up and you look one day and you realize you're just rich, you diversify. You diversify to stay rich. Path two, just get rich slowly. You know, you can probably count on reinvesting dividends and the total stock market index returning a minimum of 6 to 7% a year. If you go your whole life satisfied with 6 or 7% returns and you're diligent about saving, if you automate that behavior, if you spend less than you make, you invest the difference, and you don't try and swing for the fences, you will end up rich.
Hello and welcome to the Optimal Agency Podcast. My name is Patrick Cummings. I'm joined as always by John Gilson. Together with you, we are exploring the ideas of agency, diving deep to discover a set of guidelines on how each of us can best operate in the day-to-day to maximize our personal autonomy, professional freedom, and ultimately our positive impact on the world. Thank you so much for tuning into the show. How are you, John?
I'm great, Patrick. Thank you.
Excellent. Happy to hear that. Every other week here on the show, we talk through a question sent to us by a listener. That's what we've got this time around. And then every other week, we have a longer discussion on how we can own our lives by becoming optimal agents. So stay tuned for that next week. Before we jump into our question, we've got one from Mike this week. If you would like to get a question into the queue, we would surely love it. The best way to do so is to head to optimalagency.co/questions, and you can fill out a quick form. Let us know what is on your mind, and we will do our best to get it into a future episode. You can also alternatively get a question in by simply responding to any one of our newsletters, which we send out every single Tuesday, and you can get on that list at optimalagency.co/newsletter. Links to both of those are in the show notes. Are you ready for this question from Mike?
Let's do it.
All right, a little bit of context from Mike. He says, my wife and I are in our mid-50s and we are realtors in Texas. We have a goal of having a $12 million net worth in 5 years so we can live a fairly big life of travel, fitness, and giving back. We are currently at $6 million net worth. We have about $1 million in the stock market and $5 million in real estate with 20 rental homes. We have about $200K per year in earned income. So that's context. Here's the question. Since the economy, stocks, bonds, and the real estate market is so unpredictable, how do we set yearly goals with any accuracy when our future net worth is so determined by appreciation of our assets, our stocks, and rental properties? The stock market could go down 10% in a year, or we could get lucky like we did during the pandemic and have a 30% appreciation of all our real estate in just 2 years. Any suggestions on how to make a plan to achieve $12 million in 5 years would be much appreciated.
So, Mike, I would also like to have $12 million in 5 years.
I was thinking that same thing.
Yeah. So,
so if you could solve that for all of us, John, that'd be fantastic.
Yeah, here we go. The first thing that comes to mind for me is, for the majority of our listeners, how unrelatable that scenario sounds. I'd like to take my net worth from 6 million to 12 million. And I think that regardless of the dollar amounts involved, the principles are the same. And so there are some really important lessons in what Mike is asking for everybody, regardless of whether your current net worth is $100 million or $100. And so we'll talk that through. And I'm going to go through 3 concepts that I think are really important here. And Mike, I'm going to answer your question somewhat peripherally, but we will get there by the end of the episode. So the first of those concepts is really, really simple. You don't want to be rich and then all of a sudden find out you're not. Okay. And the most likely way for that to happen, get rich and then lose it all, right, is either to sign a pro sports contract or, right, to concentrate your wealth in one asset class. So I want to give you an illustration and a story. So in 2010, I got a wire into the Again Faster Equipment bank account for $4 million. That was a private equity investment that had valued the overall business at $10 million. And because I owned 51% of that business, I instantly, according to that valuation anyway, was worth $5.1 million. Well, fast forward the tape about 3 years, and I had liquidated the company and actually had to come up with $90,000 out of my own pocket to get rid of the remaining debt after everything was said and done. I round tripped, and I don't recommend it. And the story here isn't I round tripped. The story is I had over 99% of my net worth in one asset, that company. And so any volatility that impacted that company instantly impacted me disproportionately. And so how does that apply to Mike's situation? Well, he has 80% of his assets in single family rental real estate. And he acknowledges this. Mike in his question says, we could get lucky like we just did, and the worth of our homes could appreciate, our real estate portfolio could appreciate 30% in 2 years. It could, right? But the odds are it's not going to do so again. In fact, if you rewind the tape a little bit further, if you go back about, let's call it, almost 20 years at this point, in 2007, 8, 9, 10, and 11, we had the subprime mortgage crisis. And from peak to trough, single-family residential real estate fell by over 20%. Now, is that likely to happen again next year? I don't know. And neither does Mike. And so what we need to think about, and what I should have thought about with the business back in 2010, and Mike should think about right now, is that diversification of your assets is the thing that protects you from a large fall. What is diversification? What does that mean? It means I want to own a lot of different income producing and passive income generating assets, capital appreciation generating assets that are uncorrelated with each other. What does that mean? Well, when one moves in one direction, I want a different asset to move in the opposite direction, right? That gives us essentially stability of wealth. And you've probably heard this if you've paid any attention to investing at all. We invest in index funds and not individual stocks because low-cost index funds have hundreds, if not thousands of stocks within them. And so the performance of any given business might be up and others in the index might be down, but on average, the businesses grow. And so the thing to think about with diversification is really simple. If you look at your assets and their mark-to-market value, that is what they're worth, you should always have to say you're sorry because some part of your portfolio must be going down if your assets are uncorrelated. If every asset in your portfolio is simultaneously going up, you're not diversified. You have very related asset classes.
Because the forces that are pushing one up is the same force that's pushing everything up. And if that force reverses, then
everything goes down. Well, let's talk about this in real context. Historically, stocks and bonds have had a below one correlation, right? So below one means they're not perfectly correlated. They'll tend to go up and down together, but in times of deep economic stress, bonds, especially treasury bonds, tend to move in the opposite way of stocks. Stocks go down, there's what's called a flight to safety, and T-bills and guaranteed income backed by the full faith and credit of the US government go up. There are other uncorrelated assets like private equity, that is the performance of private businesses, tends to be fairly uncorrelated with the performance of the public stock market. Again, it's not negative one. They don't move perfectly in opposite directions, but they have a correlation of less than one. And so diversification is the way, once you've gotten rich, to make sure you don't round trip. So that's the first thing. Look at your assets, whether you're a realtor in Texas or whether you're just looking at this podcast and say, are these perfectly correlated? If they are, you've got an issue. Okay. Now, I think that we need to understand what that boils down to, which is your first task is not to double your wealth. It's to keep the wealth you already have if that wealth is sufficient. I'm going to argue, regardless of how big a life you want to live, $6 million is sufficient. Of course, I'm imposing my values on our questioner, which is never appropriate. However, that's a lot of money, brah. Okay.
Yeah.
So the second thing that this illustrates to me with that concentration risk in single family real estate is single family rental real estate is very illiquid. What does that mean? Well, it's, dude, it's hard to sell, and it has high friction transaction costs. So prior to the real estate industry recently experiencing a spate of lawsuits over collusion and over its insistence on a 5 to 6% transaction cost, you were going to pay, as the seller of a piece of real estate, 6% on that transaction just to move a house. Well, what does that mean? It means on $1 million house, you're going to pay $60,000 in commissions just to sell it. And that selling time in an up market might be 2 days. But in a low demand market, in a cyclically down market, it might be 6 months. And so if we need money quickly, we don't want our assets to have high transaction costs, and we don't want them to be hard to move. Okay, so how does this play out? So let's say I want to move from the accumulation phase to the drawdown phase. I want to stop saving money, investing money, etc., at least actively. I want to stop trying to improve my net worth, and I want to start spending. And this is what happens to everybody at retirement. There are two sources of the money you need to pay your bills, to do that travel, to do that philanthropy, to live the life you want. Source one is the yield on your investments. That's the dividends that are paid. That doesn't actually move your principal down. Your wealth on paper stays the same, ignoring inflation, and you just get cash payments, dividends. Okay. I think with a single family real estate portfolio, residential real estate portfolio, that yield's actually pretty good. Over the last 20 years, it's about 5.6%. Okay? A 5.6% rental yield on $5 million says before taxes, they're getting $250,000 a year in cash flow. Hey, not bad. But the other source is drawdown. And what's drawdown? It's selling the asset itself to help meet your cash flow needs. And again, when you own 20 homes, that's fairly difficult to do. Probably less difficult for a pair of realtors, but they can't, no matter how good they are at selling homes, they're not going to overcome cyclicality in the market. And so with 80% of their net worth in a fairly illiquid vehicle that's hard to draw down in tiny chunks, right? They've at minimum got to sell the whole house. You can't sell part of a house, right? You have a hard time with a drawdown strategy. Let's talk about a traditional drawdown strategy really quickly here. Something called the Trinity study found that on a 60-40 split between stocks and bonds in a portfolio meant to last 30 years, which is about the lifetime expectancy of our realtors in their mid-50s, right? They've probably reached their high 80s, maybe their 90s. They've got about a 30-year time horizon. The drawdown rate with 100% success, that is selling the assets and never running out of money, is 4%. According to that study, a 4% initial withdrawal, not 4% every year. It actually gets indexed for inflation. But keep in mind now, what that means is they can get income from their rental properties and they can sell them down at 4%. Well, what's the problem when you own 20 properties? The least amount you can sell down is 5% of that portfolio, assuming those houses are equally valued. Okay, so what does that point to? First, you need liquidity to have a drawdown strategy. Two, diversification would really help here. Okay? You can get really rich with those single family homes, but it would be helpful if you could sell part of one and you really, really, really can't. Okay? Add in the fact that real estate's highly cyclical in its value. And I think what you're setting yourself up for here isn't a happy retirement with $12 million. I think you're setting yourself up for an evil round trip with a hard time drawing down. The risk here is really simple. You can end up what's called house rich and cash poor. That is, most of my net worth is tied up in an asset that's illiquid. My house. This happens to a lot of people.
Yeah, I was going to ask you that, is because that to me feels like far more the case than Mike here is that we're undiversified because our biggest asset is the house that we live in, that our primary residence, right? And so where does that fit into this conversation of diversification and of illiquidity?
Well, so Mike is in a very analogous situation. It's not house rich, cash poor. He and his partner are qualified rich, cash poor. In other words, they've got $6 million in net worth, and their ability to immediately access it is less than 20% of it through the sale of just their stocks and bonds in that portfolio. Now, they're not that cash poor if they're generating $250,000 a year in rent and $200,000 in earned income, but this is relative to your overall net worth. And the idea is you never want to be caught in a situation where you suddenly find yourself needing to access your net worth and you can't. And you can't. Right. So the thing that we now have to turn our attention to is the goal. And if the goal is to double your net worth in 5 years, there's a really simple heuristic they teach in finance that will help anybody here to say, how long will it take my money to double, period? Okay, so how long will it take my money to double at any given interest rate? It's called the rule of 72. What you do is you divide the interest rate into 72, and it tells you approximately how long in years it would take that money to double. So by the rule of 72, if I'm earning 10% a year, it would take about 7 years for my money to double. Now, Micah said, I want to go from 6 to 12 in 5 years. So instead of dividing by the interest rate, we can just divide by the number of years. It's mathematically equivalent. Okay. So 72 divided by 5 years says essentially that he needs just under a 15% return per year in order to get from 6 to 12. I have bad news. 15% annual returns, even leveraged returns, meaning he's borrowed money to buy houses, etc., which does increase your cash on cash return, is very difficult to achieve unless you own a giant quantitative hedge fund. Okay. It is not an accessible rate of return for the average investor. And if you pursue it, you are almost certainly going to take on undue risk that makes the possibility of round tripping very, very probable. Okay. So if we know that he needs 15% returns per year, I think it's worth looking at, well, what are the returns on residential real estate? Let's say you ignore me. You don't care about liquidity. You don't care about diversification. You're a realtor. You're making money doing what you know, which is buying houses and renting them out. Okay. So I went ahead and looked at the last 20 years of data. Now, this is secondhand from a company called Arrived, which sells essentially a private mutual fund that allows people to invest in rental real estate. And they calculated that the average 20-year leveraged return, including a mortgage, that is 65% debt on that, is 11.7%. Okay. So if we use the last 2 decades of data, Mike, what you can count on if you don't listen to me and you don't diversify anything is an 11.7% return. Well, let's use our rule of 72 again and say that it's going to go in there about 6.5 times. So what would I do? Pretty easy. The first thing I would do is add to your time frame. It's not 5 years now. Make it 7. Make it 8 so that you have some shot at a reasonable rate of return. Okay. If, however, you choose to diversify and you choose to diversify into a 60-40 stock and bond portfolio that will give you drawdown, that will give you liquidity, et cetera, you can probably count on a rate of return blended of about 7%, which says that if you want to get from 6 to 12, you're not going to do it in million. You're not going to do it in 5 years. You're going to do it in 10. Okay. So lengthen that out. But what I would say, and this is for everybody, your goal should never be to get high returns quickly. That's not how compounding works. Okay, and compounding is a force of the universe. And so at risk of being somewhat woo-woo, do not try and shortcut it. You will not win. Okay, and so the goal is not to get high returns quickly. It's to get reasonable returns forever, every year, in and out, and have enough liquidity and diversification that the volatility of your portfolio when you need to go in and get that money is low. Okay, so how do you do this? There's 2 ways. One, you concentrate to get rich. You do what Patrick and I did. You build a company. You do what Mike and his wife did. You build a portfolio of residential real estate. You concentrate to get rich quickly. See, it's really the only good way to do it, but it also comes with the risk of round tripping. And so when you're rich, when you wake up and you look one day and you do not what I did, and you look and you realize you're just rich, you diversify. You diversify to stay rich. Okay, so that's path one. And I actually want to come back to path one here. Okay. Path two, just get rich slowly. Just get rich slowly. You can probably count on, reinvesting dividends and the total stock market index returning a minimum of 6 to 7% a year. If you go your whole life satisfied with 6 or 7% returns and you're diligent about saving, if you automate that behavior, if you spend less than you make and you invest the difference and you don't try and swing for the fences, you will end up rich. Almost certainly. So get rich slowly. But let's get back to concentrate to get rich, diversify to stay rich. So I started investing in 2004 in the 401k of our employer, the Boston Private Bank. Mm-hmm. I very, very quickly, in learning about personal finance, ended up in a investing program, a finance program at the Harvard Extension School, where I studied investments under basically a panoply of Harvard professors. And I went in and I said, I understand businesses and I understand what Patrick and I ended up doing in the next several years, which was investing in e-commerce. And so I did the same. I invested in Amazon. I bought Facebook's IPO, right? I invested in Apple. Everybody had the iPod Nano on the T, and I was like, this seems like
the white headphones
and the white on the recorded white headphones that said I'm cool. And I very, very quickly started putting my money into that. I didn't have very much money, but when I looked at my portfolio again in 2021, so about 15 years later, I realized when I divided by my monthly expenses that I could retire right at the age of 40. I was like, oh, wait a minute, I have enough money and I'm incredibly concentrated in tech. And so I went ahead and I diversified the hell out of my portfolio. I went from investing in stocks, individual issues, individual companies, to index funds. I said, okay, I've gotten rich. This is enough money. Stop pursuing more and make sure you can keep what you've got. And it turned out to be a fairly prescient thing to do, and very glad that I did it. But maybe the smarter thing to do would have been to have never concentrated my wealth in the first place in that handful of names that did really well, because there was no smart process there. That was luck, straight up luck. I wrote 15 years of luck because I saw something happening. I said, I think this is worth money. I didn't analyze a balance sheet. I never went in and said this is kicking off tons of cash flow, although Apple, I did look and say they have more cash on their balance sheet basically than the stock costs. But, other than that, there wasn't any skill there. I got lucky. And so if you're lucky, Mike, guess what? You're lucky. You're not smart. You're lucky. Just take it on board, brother, even if you disagree with me. Anyway, I hope that helps. I think that we want to avoid round tripping through diversification. We want to avoid being house rich and cash poor, or qualified rich and cash poor, by pursuing liquidity through that diversification. And keep in mind the rule of 72. If you've got a goal that you divide into 72, either in years or percentages, to double your income, and it comes out to a wacky high number, you need to change your goal.
I think the one question I've got is, Mike's question started from, and is really based out of, like, I have this goal of a certain amount of net worth. Did he start from, at least in, this conversation feels like what you're saying is that's not the right target to be aimed at, but I want to make sure I ask that question so I'm not assuming too much. Is he starting from, by saying, like, my goal here, my question to you is, how do I get from 5 million or 6 million to 12 million net worth? Is that the first place maybe he took a left when he should have taken a right?
Absolutely. It's the wrong scorecard. And here's why it's the wrong scorecard. And let me illustrate it by telling you not why it's wrong, but what I would do instead. I would put a number on my big life. If I want to do travel, fitness, and giving back, how much does that cost annually? How much does that cost annually? Okay. Then I would take that number and I'd divide it by a reasonable drawdown plus yield number. So let's say it costs $1 million a year. Okay. That's huge, right? I then divide by what's reasonable for a drawdown strategy? Let's divide by 6%. Right. So 6% will go in there about 7-8 times. Okay. So to live on that $1 million a year, right, he would need about $70-80 million in net worth. He's working it backwards. Okay. What you would actually want to look at instead is to say, I need this much money. Can I get this much money from the yield on assets that I don't have to sell down? That would be my first stop. And I would actually, if we were doing the whole lay down on the couch, Mike, let's talk, like you stare at the ceiling and I'll be like, oh, I have to question your subconscious. Like what I would start doing is saying, why do you want that big life? What does it mean to you? What does that travel mean to you? Is that exploration? What do you need to explore? And good Lord, why do you need $12 million in drawable net worth to do it? Genuinely, right? Because if you look at that from a drawdown rate of about, again, 5%, if we can do that, right, we're talking about $600,000 a year in spending. That's a great life. But so is $300,000 a year in spending if it's appropriately formulated. And so I would start at the root level. Why do you want what you want? And I'd ask the same of anybody listening to this. If you just have a financial goal, why do you want what you want? And why can't you do it for half as much, for a quarter as much? And as soon as you answer in the affirmative that you can, guess what? You don't have to wait 10 years to retire because you can do it right now.
Love it. All right, we're going to wrap it up there. Thank you, Mike, for the question. Again, if you would like to get a question into a future episode, we would love it. optimalagency.co/questions is the best way. The link to that is in the show notes. John and I will be back next week for another episode of Optimal Agency.